Hello, good day to you all. You are welcome once again to my YouTube channel. My name is Dr. Obafemi Oyewumi, and I'm delighted to have you here listening and watching this particular video. Now, this video is all about taxation. We're diving into taxation, and we're looking at a particular topic that is very, very important and germane, to our understanding of the tax laws as it relates to capital gains. Capital gains tax is what we are focusing on as a topic, but we're looking at the provisions in Nigeria, capital gains tax provisions in Nigeria. So that's specifically what the topic is all about. Now, let me just share my screen so that we can follow appropriately. Just give me a moment, please. A moment for me to do that. Okay, I want to believe that you are seeing my screen even right now, wherever you are, at this particular point. Now, let me just put it in the presentation mode so that we can follow and see everything clearly. All right, so here we are. Capital gains tax provisions in Nigeria, part one, the A part of it, the first part of it. That's what we're looking at, today. Now, when we talk about capital gains, what are we referring to? Okay, basically, they are gains that are of capital nature. Okay, that's the basic understanding that I want us to have. Now, when we sell, qualifying, assets, okay, qualified capital expenditure, in accounting, you have what is called at the end of the profit or loss on disposal of assets. Profit or loss on disposal of assets. That's the interplay of the cost and depreciation and the sales proceeds at the end of the day. But then we're saying here that when the law says that when you sell a particular property, you make gains. And then the gains too will also be subjected to tax. And the gains that you're talking about, because the asset, you're selling an asset that's of a capital nature, then it means that whatever comes out of it is not just going to be taken, the tax law will not go to be regarded as a profit, rather it's going to take it as a gain, okay, or the loss as the case may be. So let's talk about capital gains, now, and I believe that we're going to have a lot to learn as we continue. What is capital gains? Capital gains refer to gains arising from the disposal of chargeable assets. That's key. That word is key. Not just any asset, but chargeable assets. That is where the sales proceeds exceed the cost of acquisition and other ancillary costs of disposal of the same capital asset. So when you sell an asset, qualifying capital expenditure, okay, the disposal of such an asset that is called chargeable asset, you have to deduct, okay, the cost of acquisition and all the costs that are associated with the sale. And then whatever it is that you get will result into either a loss or a profit. And of course, we talk about gains or loss. All right. So the defining factor here is capital. What is capital here now? Capital refers to whether you're using, an asset for the purpose of generating income. Okay, for the purpose of generating income, that's the dividing, line. All right. So the proceeds of an asset acquired or kept for use as an investment shall be treated as capital receipt, and any gain thereon shall be regarded as a capital gain. So if you made a gain, then you have capital gain. Okay, if it's also a loss, then you have a capital loss. So what is key is that if it's a qualifying capital expenditure that are used for the purpose of generating income, then you know that you're going to be talking about gains. But then if it is something that you deal in and you sell, if that's your trades, what your stock items, if that's your inventory, if that's what you deal in, for example, if you sell computers, whatever you sell at that particular point in time, it's not going to be counted as a gain, but rather it's going to be taken as a profit. All right, and that will be subjected to either personal income tax or company income tax, as the case may be. All right, so let's talk about capital gains tax. Now we've had I believe we have an idea now of what capital gains is all about. Now let's talk about capital gains tax, the tax emanating from the capital gains. What is capital gains tax? This is the tax imposed on gains arising from the ownership of a capital asset changing hands, either by exchange, transfer, sale, or gift. So when you change, ownership of a capital asset, all right, and a gain arises, then a tax is also imposed on it. So whether it's via transfer, whether it's by sale, this time around you are selling it, or by gift, when you gift someone your asset, again, it can also warrant, capital gains tax. All right, so that's capital gains tax in a nutshell. Okay, tax imposed on gains arising from the ownership of a capital asset changing, hands. When you exchange it, the ownership has been changed to someone else, then that we talk about capital gains, tax. All right, let's look at the, from historical perspective, and look at the enabling laws, guiding this particular act. The principal act came out in 1967. The principal act is called, Capital Gains Act. Okay, the principal act, Capital Gains Tax Act of 1967. Okay, it came to effect in 1967 and 1966 assessment year. The principal act, together with all amendments thereto, has been reenacted as Capital Gains Tax Act Cap 1 C1 of the laws of the Federation of Nigeria 2004. So the recent one, before the other amendments coming from the different finance acts, and even recently the Nigeria Tax Act. Okay, that's the perspective that we have to take into consideration when we look at the history behind this particular tax. All right, now let's look at the administration. What is the administration? How is it administered? So for corporate bodies are not residents, okay, the administration lies with Federal Revenue Service. Now, NRS. The new word is NRS, Nigerian Revenue Service. Okay, so it lies with this particular service. But for individuals, okay, apart from those residing in Abuja Federal Capital Territory, the administration lies with State Board of Internal Revenue, State Boards of Internal Revenue. And of course, for those staying in Abuja, okay, residing in Abuja, of course, again, the FCT, Internal Revenue Service, administer such capital gains, tax. All right. Now, let's look at capital gains tax imposition. Capital gains tax imposition. Okay, so capital gains tax is chargeable on the total amount of the chargeable gains arising after deducting allowable expenses on the disposal of such chargeable assets in a year of assessment. So it's a tax that's on charge, that's on the amount, okay, the amount of the gains that you realize after deducting allowable expenses relating to the sale, the disposal, not just any other allowable expenses. There could be some allowable expenses that, when it comes to the regular CIT, that's allowable expenses when it comes to computation of company income tax. They may not be allowable when it comes to this particular one. So you have to take note of this particular definition. All right. So chargeable persons, who are the people that should pay, companies income tax? Any company or body corporate established by or under any law in force in Nigeria. So corporate organizations. Then again, for individuals that sell, their assets as well, they are also liable to pay capital gains tax, but this time around under PIT, that's personal income, tax. So that's what you have to take note, there. So let's continue still. Let's look at the computation. Okay, what are those deductions that are liable when it comes to, computation of capital gains tax? Number one, the cost of acquisition or the purchase price. All right, including all incidental costs to the purchase. Then number two, improvement cost. Peradventure, you've actually improved on the value of the asset. Then that one's also, allowable. Okay, that talks about a cost that is wholly, reasonably, and exclusively and necessarily incurred. Okay, for you to be able to improve on the cost of the asset. Now, cost wholly and reasonably, exclusively, and necessarily incurred in establishing and preserving or defending the owner's statute is also part of it. Selling expenses Okay, all those expenses that are, connected to the disposal. For example, we talk about maybe a fee to an agent, for example, commission to an agent, or maybe remuneration paid to a professional service, a professional, okay, a surveyor, a valuer, an auctioneer, an accountant. So all of this will come into play. They are liable. These are liable expenses. Cost of transfer, okay, cost of transfer of the deed, for example, you are moving, it's been registered in your name before, now you want to transfer the deed, cost of transfer, okay, advertisement cost, if any. So maybe the cost of buying or the cost of selling, you have advertised, for buyers to come and buy. So it's also liable. Then cost reasonably incurred to make any valuation or appointment required for the purpose of computing the capital gains, including expenses in ascertaining market value where required. So these are the elements, these are the costs that are liable for the purpose of calculating or computing capital gains tax. What about disallowable expenses? So we're saying some are liable as a deduction in computing the profit or gains or losses of a trade for income tax purposes are not a liable deduction under this. I've said that before, so you have to take note of that. Insurance premium on the asset are not liable. So while insurance is allowed for regular business, transactions, for the purpose of this, is not allowed. So those are the things you have to take note of. These two items. Now, what is the rate of capital gains tax? The capital gains tax Act of 2004 has amended and imposed a tax rate of 10%. So just 10% on the total amount of the chargeable gains. Now it's the chargeable gains, not on the disposal value, chargeable gains. That's why you have to get your chargeable gains correctly. Okay, after making some deductions, and may be allowed in the computation of such gains. So you deduct the cost of acquisition, you deduct the other allowable expenses, all right, and then you can now apply the sum of 10%. It used to be 20%, before 1995. Okay, so let's continue. Okay, year of assessment. We're saying that in relation to capital gains tax, the year of assessment means a year beginning with January 1 and ending December 31 in the same calendar year. Okay, this took effect from 1969. So, okay, so it means that the tax, when it comes to companies income tax, capital gains tax, is usually on the on actual year basis, and this is determined by the year of disposal. The year of disposal of any chargeable asset. The year of disposal is the year they're going to be using as the year of assessment. Okay, now let's look at chargeable assets. What are the assets that you can actually charge withholding tax on? Okay, they are here: options, debts, and incorporeal property generally. Okay, incorporeal means assets that are not real, fictitious assets. Okay, they are they are actually one could charge tax on it. Any currency other than Nigerian currency is also subset. It's also chargeable. Any form of property created by the person disposing of it or otherwise coming to be owned without being accrued. All right, so that's what you have: stock and shares and every description. So these are items of assets that you have to that will be subject to capital gains tax. All right, disposal of asset. When we say disposal of asset, what are we really referring to? Of course, basically, it talks about when an asset changes hand. When a particular asset, the ownership changes, okay, from the person that is selling to the person that is buying. Basically, that's what it is, okay? But then in the law, let's look at it the way it's been stated. Say that where a capital sum is derived by way of compensation for any loss of office, this is another one, or even employment. So the first one is that provides that there is a disposal of asset by a person where any capital sum is derived from a sale. So when you sell, when you lease, when you transfer, or you assign, okay, that will bring about a formation of a gain. All right, that will bring about a gain. All right, so okay, so now there are other variants, relating to this, where some capital sum is derived by way of compensation for loss of office. When you lose office and you derive, but of course we soon get to that in part 2. Okay, that's a threshold when it comes to compensation for any loss of office. Where any capital sum is received under the policy of insurance and the risk of any kind of damage or injury to or the loss of depreciation of assets. So in the event that maybe an asset is lost and then an insurance company pays a particular portion back to you, all right, it means that that such an asset could be, be subjected to capital gain tax. Okay, it depends on whether it's a gain or a loss. So where capital sum is received in return for the forfeiture or surrender of rights, where capital sum is received as consideration for use of exploitation of any asset, where capital sum is received in connection with or arises by virtue of any trade, business, profession, or vocation. You can see that we're talking about capital sum when they come in, capital sum, arising from an exchange, arising from the disposal. Okay, when you receive a capital sum, not revenue, it means that you have to calculate and determine whether you have actually sold at a loss or at a gain. And of course, you're going to treat them appropriately. So that talks about the disposal of assets. Now, I want us to look at the format. Okay, there's a format that we have here, format of computing, okay, that we have to follow, and please pay attention to this. So the currency is in error, the currency, it is there. Sales proceed, we have the amount there. Incidental costs of selling the asset. First and foremost, you deduct all the costs associated with the selling of the asset, the disposal of the asset. So you deduct that one, and then you arrive at your net sales proceeds. Net sales proceeds, okay? And then you now talk about the cost of acquisition of the asset. Okay, how much did you pay, the cash outlay, for the purpose of acquiring the asset at the very beginning? So you deduct it, then you arrive at what is called, capital gains. And then you now remove rollover relief. Rollover relief. Now we're going to talk about this, later on. Okay, rollover relief, maybe part 2. Okay, rollover relief. Rollover relief is saying that the lower of sales proceeds or amount reinvested or less cost of acquisition. All right. So rollover relief is saying that it is possible for you to actually reinvest the money that you earned or that you collected, that you received for the purpose of selling the asset. Okay, if you reinvest the money into another property, another asset that is within the same line, okay, and then by the time you deduct it, there will be a rollover relief at the end of the day that will be granted unto you as an individual before you arrive at the chargeable gain, and then chargeable tax that will also be payable if you apply 10% to it. So let's talk about rollover relief. I think it's also in this particular slide now, this particular one, rollover relief. Okay, rollover relief is given when the sales proceeds from the disposal of chargeable assets are utilized. When the sales proceeds are utilized to acquire new assets of the same class, they must be in the same class. Take note, same class. The motor vehicle is a vehicle. For example, when you sell one and use to buy another one, you know that that's a class. So you cannot sell machinery, okay, and come and claim rollover relief when you purchase a motor vehicle. That's what it means. But the following conditions too must also be fulfilled. Number one, the new asset must be in the same class, like we said. Then the amount invested in new asset must be greater than the cost of the old asset disposed. Please take note of this particular one. The amount invested in the new asset must be greater than the cost of the old asset disposed. So if you got any gain in the process of selling or disposing the old asset, all right, if you are not going to reinvest the money, it must be, for example, plus the initial cost, because you must have earned more. So meaning that the amount invested must be greater than the cost of the old asset that you dispose. That's number two. Number three, the cost of the new asset acquired must be greater than the sales proceeds of the disposed asset. The cost of the new asset acquired must be greater than the proceeds of the disposed asset, and then the sale of the old asset must have resulted in the capital gain. That's the very first basic thing. If it does not result in capital gain, then these conditions will not be fully met, and so you cannot claim rollover relief. Please take note of this important conditions. Please take note as much as possible. Now, let's have an illustrative question here. Mr. Lagwaja is a realtor, and then in 2024, okay, pardon me, this is supposed to be 2023. Can I quickly, this is supposed to be this 2024, supposed to be 2023. Please take note. I don't know if I can quickly effect the change here. Let's see. I believe that you can still see. All right, so I've effected it now. 2023. All right, so let's go back. All right, so 2023, that's what we have. Thank you for your patience. So let's look at it now. This man purchased penthouse of 50 million and renovated it with 3.5 million. January 30th, he paid land use charge of 1.4 to Lagos State government. In 2024, February 13, he bought a warehouse for 25,450,000 and renovated it with 2.750 million. And then on the 14th of March, he bought shares of 100,500 First Bank at the rate of 17.5 per share, purchased a 2-bedroom apartment for 45 million and renovated it with 5,500,000 on the 25th of April. And then on 30th of June 2024, he paid a penalty of 1.5 million for late registration of the deed of assignment for the properties. And then December 16, 2024, he sold the house that he purchased for 50 million. He sold it for 71 million. The warehouse too was sold for 45,450,000. And then the 2-bedroom apartment for 65 million. To dispose of this asset, he paid agency fee of 1.5, 2.5, and 1.8 for the purpose of for the house, for welfare and warehouse, rather, this part of the warehouse, and then 2-bedroom apartment. So he sold everything on the same day and got 71 for the penthouse, and then he got 45 million, 450,000 for the warehouse, and then the 2-bedroom apartment, okay, that was bought at the rate of 45. He sold it at 65,000 naira. All right. So to dispose of this asset, he paid agency fees of 1.5, 2.5, and then 1.8 for the purpose of for the house, warehouse, and 2-bedroom apartment, respectively. He also paid advertisement fees of these figures, for the 3 buildings, respectively. Now, let me change the narrative somehow, somewhere. Okay, meaning putting the word there, realtor, means that he actually deals in this particular, might mean that he deals with this particular, trade. That's to say that buying and selling of houses, that's his trademark. That's what he does. So let me pull this. Let me change this narrative. Okay, who is a consultant? Okay, a consultant, a businessman. Let me just change it like that. Okay, so that's let's leave it like that. So change it to a consultant. Okay, I think that will define it properly for us. Now let's go to the solution. Now, before we go into that, what we say should do. So say calculate the capital gains payable by Mr. Lagwaja. Okay, calculate the capital gains payable by Mr. Lagwaja. So let's go and see the whole thing. So for the first building, that's a penthouse. Okay, penthouse. Remember, we're talking about 3 houses. The first one, a penthouse, 50 million, using 3.5 to renovate it. Okay, and sold it for 71 million. So those are the things that you have to take note of there. So sales proceed, how much? 71 million. Now, the cost of selling the particular, this asset, okay, will come in first. How much for agency fee? 1.5 million. 1.5 million. So we said agency fee, okay, of 1.5 million naira. for the house. Okay, that's the penthouse, then warehouse, and then 2-bedroom apartment. So 1.5, and then again, advertisement fee, okay, of this amount, and then coming in respectively as well. Okay, so we have to also consider that as well. Okay, I'm just trying to correct this as much as possible so that when anybody is looking at it, you'll be able to have an idea of what we did here. Pardon me for this corrections that are coming up now. Okay, so here we are, and apartment respectively. Okay, respectively. Okay, so that's what we have, and then we have this. So that's what we are putting up, here. Now let's look at the solution for the penthouse, 71 million. So you sold for 7 million naira, and of course incur this cost, agency fee of 1.5, advertising fee of 1.1 million naira, then totaling 2.5, deducting this from this, arriving at 69 million, and then the cost of acquisition. Okay, this time around, cost of acquisition cost is how much? 50 million. And of course, he spent 3.5. Remember, to renovate the property at the point of acquisition. So we got this at the end of the day, this capital gains, and then capital gains tax at the rate of 10% will give 1.5 million naira. So that's talking about the penthouse. I believe it's very clear to all. Okay, capital gains tax of 1.55 million naira. So that's what we got at the end of this particular one. So let's talk about let's look at the next building. It's sold warehouse. Okay, at the rate of 45 million for 50, agency fee of 2.5, advertising fee of 1.2, arriving at 3.7, and then at the end of the day, resulting into a net sales proceed of 41 million naira. 41 million naira. Okay, 41 million naira, 750,000, and then deducting the acquisition fee and renovation cost, again arriving at this figure. And by the time you deduct, this 20 million or 200 from this, you arrive at 13 million 549. And by the time you apply the costs, by the time you apply 10% to it, you arrive at 1.354950. 950. All right. So let's look at the third one. Third one is the 2-bedroom apartment, 2-bedroom apartment. 65 million naira, was the cost of the disposal value. Okay, agency fee 1.8, 1.35 is the advertising fee, and the total 3.6, 3.1. By the time you deduct this one from this, you arrive at 61,850,000. Then by the time you take the acquisition cost and renovation cost of 50 million from this, okay, then you arrive at 11,350,000. And then by the time you apply the capital gains tax of 10%, you arrive at this figure of 1.135 million. So that's in the first part of this particular lecture, that's what we arrive at. So we'll be going to the second part, and of course the other details you find in the second part, talking about all other variants of withholding capital gains tax. So I want to appreciate you for watching, and I believe that you have learned one or two things from this. Okay, and I want to say that if you gain anything whatsoever, endeavor to, number one, share it so that others will see it. Number two, like it. Number three, what must you do? Again, if you gain anything, okay, if you have any comments whatsoever, please put it there. I will see it, and then I will make comments, eventually. And then, of course, subscribe to my YouTube channel if you are yet to do that. If you are yet to do that, please subscribe so that you can get to know and be part of subsequent videos that will be coming up, later on. Thank you very much for being part of it. See you very, very soon. All right.